Hello, my name is Celia Anderson, and I am president of CFA Society Atlanta. Welcome to our online webinar, Navigating China 2022 and the Future of China's Internet Sector. Before I introduce today's speaker, I do need to pass along a few programming notes. First, our online series continues with the annual SEC update next week on February the 16th. Next, we will be hosting our in-person 2022 Southern Classic Research Challenge on February the 26th. And finally, the Women in Finance Networking Mixer and panel discussion, and yes, men, you are cordially invited to this, will occur on the evening of March 9th. For additional details, as well as to register for these or other events, please visit our website, cfaatlanta.org. Now, for today's event, we're joined by our speaker, Brendan Ahern, Chief Investment Officer at KraneShares. Many of you will have heard of KraneShares ETF, KWEB. Brendan's full bio is available at our website, cfaatlanta.org. Please submit your questions via the Q&A feature within the Zoom controls at the bottom of your screen. And with that, I'll turn it over to Brendan. Brendan, all yours.
All right, thank you very much, Celia, Kathy, and the entire CFA Society of Atlanta. Very much appreciate this opportunity. I'm just going to dive right in just very quickly about KraneShares. We're a China and emerging markets focused ETF provider. Our greatest value add, I believe, is our research, our insights into trying to provide a balanced perspective of what's happening in China. I write a daily research blog called ChinaLastNight.com that's very simply tries to really show what's most relevant of what's happening in terms of China's capital markets and economy on a daily basis. In full disclosure, KraneShares, we started the firm, we were self-funded going back to 2012. We're privileged to manage about 14 billion of clients' assets today. We actually sold a piece of our company to China International Capital Corp. CICC was the first investment bank in China, co-founded by Morgan Stanley in the mid-1990s. And an element of our research is derived by our colleagues in mainland China, and they're economists, and they've won Institutional Investors All China Research Survey 9 years in a row. But certainly they're just a piece of our important research ecosystem. Just let's dive right in. What's happening in China, and the timing for this event could never be better, because last night, for those of us who ply our wares in the passive investment world, it was a very important night because MSCI provided the pro forma for their end of the month quarterly index review. So MSCI has the two quarterlies, and then their big rebalances, the big semi-annual index reviews are, end of May, end of November. But last night there was some surprises. You'll probably notice the outperformance of Grab, which is a Grab, Lufax, and AirCap were kind of surprise additions to more MSCI indices, and those stocks are reacting really positively, as well as we have the final inclusion of Southeast Asia e-commerce company C. But for those more focused on the emerging markets, it really reaffirmed the necessity of having a China opinion. That you can see that numerically, China is a disproportionate weight within MSCI indices, that numerically it's more than half of the stocks, though from a free float market cap perspective, it's about a third of the index. And certainly over the next several years, we anticipate this percentage is only going to increase. That a reason that there's so many Chinese stocks in MSCI indices is due to MSCI's partial inclusion of Chinese A shares. And they've only added 20% of the potential market cap of about 500 Chinese A shares, Shanghai and Shenzhen stocks. But we anticipate that could change over the next potential years or decades to come, where we think China, similar to Japan, is going through a process of really dominating the benchmark. And we're starting to see more talk institutionally about China as an asset class. It's just simply too big. And the MSCI pro forma provided last night only reaffirms, and hopefully, for KraneShares, we endeavor to earn the trust of investors through our research to help navigate changes such as MSCI's inclusion. Now, several months ago, one of my favorite journalists, Jason Zweig, he writes the Intelligent Investor column, wrote a piece saying that China's uninvestable. And I beg to differ. I politely disagree. And I think part of what is missed by investors is that there's the view that emerging markets and/or China are out of favor, that they've significantly underperformed. And that is true if you're using general broad definitions of emerging markets in China. So since the global financial crisis low, as of yesterday's close, the S&P 500 is up 777%, and MSCI emerging markets is only up 262%. MSCI China is up 231%. So it's out of favor. And if you're a financial advisor, that's 50 quarterly client conversations, or if you're on an investment committee, you 50 times you have to explain why you hold something that continues to underperform. But what I think that misses is the reality that over the last decade, we've been in a growth geared market. And if we simply look at a growth element of EM, a growth element of China, lo and behold, we have a very, very different performance result. So S&P 500, again, up 777%. MSCI emerging markets is up 262. MSCI China, a mere 231. But MSCI emerging market tech is up over 1,000%. MSCI China Tech is up 2,797%. It actually ran circles around the S&P 500. So China and EM are not out of favor. It's just, if we went and looked at the sector composition of those indices a decade ago, it was all value sectors: financials, energy, industrials, materials. And very simply, you had de minimis exposure in these broad benchmarks to growth sectors such as tech. And certainly the definition of tech has evolved from an indexing perspective, that now we have a communications sector and elements of consumer discretionary. Amazon and Alibaba, for instance, are no longer tech stocks. They're in the consumer discretionary bucket. Similar to Facebook and Tencent migrated out of the tech bucket into the communications sector. So again, that's an element of what we've tried to do at KraneShares, be a little smarter about the exposures within our exchange traded funds. And that was something I've been in the passive investment space going on over 20 years now. Really, my definitive element of my career was working for Barclays Global Investors, subsequently BlackRock, within the iShares, their ETF unit. And we're not the only ones to notice this. I love this quote from Chase Coleman of Tiger Global, where when they held their client conference in the late spring, they were asked, why do you keep doing all these China deals? And he said, well, basically that's where the growth is. And we're definitely believers in that as well. Now, fortunately for not only for Tiger Global, but other famous China investors like Hill House, it was last year was a difficult year. But what's interesting is that not all of China had a bad year. That last year was very interesting because you had a huge disparity between what was your definition of China. That if you were an FX trader, all this talk about the dollar rallying, the renminbi actually appreciated 2% in calendar year 2021. If we went a little bit back, the Chinese renminbi was at 720. Today, I think it closed at 636. Tremendous appreciation versus the dollar. So, if you were an FX trader and made China, could have been the best part of your portfolio. If you were a fixed income investor, Chinese treasuries down to 10-year Chinese treasuries down to, I think, about 743. Went up last year about 6% in dollar terms. So, if you were a bond manager and you owned Chinese treasuries last year, it could have been one of the best parts of your portfolio. If your definition of China was the Shanghai Shenzhen, the A share market, you could have had a great year last year. Calendar year 2021 in US dollar terms, the Shanghai Composite went up basically 10%, 9.93%. The Shenzhen went up 12.68. And unfortunately, though, foreigners tend to invest when it comes to China in Hong Kong and US stocks. The Hang Seng declined 12% last year. And CL mentioned KWEB, our flagship ETF focused on China, internet and e-commerce companies. That declined basically 50% last year. So what's important for investors to realize is you had this huge performance disparity within Chinese equity markets. Now, what's driving that? Well, the primary investor in the Shanghai and Shenzhen market are investors in China. And we can contrast that again with foreign investors tend to stick with Hong Kong and US names. Now, why was the perception so different between investors in China versus foreign investors? And I kind of use use Evergrande as an example. That Western media says that Evergrande is China's Lehman moment, that it's going to be the first domino leading to a financial crisis. And we're kind of bombarded with news about how Evergrande's going to implode China. But in China, no one's worried about Evergrande. It's too big to fail. And Evergrande is too big to fail, not because they've got, a pretty significant $300 billion of debt. They owe 120 banks. But the reason no one believes that Evergrande will be an outright default is because of the exposure by domestic constituents. And what I mean by that is Chinese households. That Evergrande grew very rapidly through taking on debt and going national all across China. And you have a lot of Chinese households have paid Evergrande for an apartment in a building that's being built. And if Evergrande were to default, just simply go away, those Chinese households would be out in the cold. That's not going to happen. On the other side of that is the investors who funded those buildings being built. They would be out in the cold. And then think about, as a property developer, they hire construction companies. So you've got a whole supply chain that wants to get paid back, construction workers, cement, the electricians, plumbers, cement mixers. You have all these people. If Evergrande simply goes tapioca, they're out in the cold. That's not going to happen. And and then the Western media is like, well, it's not just Evergrande. All of Chinese real estate developers are in trouble. Well, that's not true. Vanke is a big property developer in China. Their bonds trade basically at par value. Now, Evergrande is not going to get bailed out. That the Chinese government isn't going to reward mismanagement by bailing the company out. But it will pay for its sins, 100%. It's just and outright, most of their debt's very short. So they're going to finish what they started, all these projects across China, at which point then it will go away. Now, I think for what we're seeing in terms of China, I think why China is very interesting right here today is because as the rest of the world prepares to tighten or is going to be tightening, China is actually easing. That we're seeing, and in the West, we tend to react to events, but in China, because of the emphasis on stability, they tend to look for potential problems like an Evergrande and head it off on the pass. And what China's seeing is that its export-driven manufacturing is slowing, that as global growth, global stimulus comes off the table, as interest rates start to get hiked, all this demand, created by global pandemic-driven stimulus, everyone went out with this free money from governments and went out and bought new iPhones, laptops, TVs, new cars, Pelotons. And what's happened is we've taken all that future purchasing, kind of this is what happened to Peloton, in my opinion, is everyone who wanted a Peloton went out and bought it. So we took several years of demand and just kind of squashed it into 1 year or into a very short time period. And now as that free money goes away, a lot of that stuff got built, or elements, inputs were manufactured in China, and that's going to slow. And we saw that more recently in the most recent PMIs. If you go in and look, the export numbers were actually starting to roll over. So what China really needs to do is they need to get domestic consumption going. And so you're seeing this monetary easing, but they'll run a fiscal deficit this year. But they really got to get consumption going, because in China, due to the draconian measures, as we're witnessing nightly watching the Olympics, the draconian measures around COVID have made Chinese households very conservative, that they're worried that, maybe the neighborhood or the city you're in, the port of Ningbo, third busiest port in the world, shut down because of two workers tested positive, and for 5 days. So you're worried that you might have COVID cases near where you live, and you're going to get quarantined. So households have been very conservative. So they gotta provide stimulus to get this consumption going, to offset the weakness that's really driven China's very strong GDP as that slackens. The other thing China really needs is a good COVID vaccine. And recently, one of our brokers in China noted that in Lancet, the UK medical journal, several Chinese researchers published their findings for peer review on a new mRNA vaccine, which if this plays out, would allow China to move away from these draconian quarantines that they don't have access to Merck, JJ, AstraZeneca, their own developed vaccines from CanSino and others have low efficacy rates. That's why they've had this. So we see domestic consumption as a very important trend, and they'll continue to navigate this balancing act on real estate, where they want to de-lever firms like Evergrande, but they can't kill real estate because it's such a big part of household wealth in China, somewhere between 40 and 60%, according to Goldman and CICC. So they've got a tricky job on real estate. Now some element of investors have noticed this strong performance of this relative outperformance of Chinese A shares. So I ran this as of today, that we can track foreign buying of Chinese, these Shanghai, Shenzhen names via the Hong Kong Stock Exchange's Connect program, Northbound Stock Connect. So we see about 100 billion's gone into Chinese A shares over the last two years and 1 month. But we can see that twice the amount of money went into Chinese A shares in 2021 versus 2020. We've had a pretty good start to this year, 4 billion. This is net of sells. Net buying, we had over 700 million of net buying of Chinese A shares from foreign investors via Stock Connect. today. And this is, if you put yourselves in the shoes of an EM manager, China is about a third of the benchmark. So you can't take China to zero. Those managers, as we'll see, are underweight China, down to about a 3.5% underweight as of the end of Q4. It was 4.5%. So we're starting to see this China underweight, but then that underweight in China has gone to India. But within the China bucket for these EM global managers, they're seeing this relative strength of Shanghai and Shenzhen relative to the Hong Kong and US names, and they're putting money into this. And that's something like we've always recommended investors hold some of these Chinese A shares just simply from a diversification benefit versus the Hong Kong and US names. But that's something that, this trend is very firmly in place. Now what does CICC think? I think, the Morgan Stanley, Jonathan Garner, his team just do a fantastic job in terms of their strategy. They remain overweight A shares. What's interesting about CICC, something that's dictated our investments in Chinese A shares, is these foreigners, when they go in and buy Chinese A shares, they're not going out and buying 4,000 of the Shanghai Shenzhen names. They're sticking to the mega cap, the biggest names. And what's interesting is what CSI on CICC has done on the left side is just said, like, listen, if you just went out and bought the 50 most widely held names, you really outperform. This is, quote unquote, free alpha. Now, unfortunately, what we're seeing in China right now is like what's happening here in the US and elsewhere globally, is this value growth rotation that investors, when they invest in China, even within these A shares, they stick to things like EV, the EV ecosystem, solar, wind, healthcare, semiconductors. And last year we had a correction in the A share market that hit these favored themes due to high commodity prices. Like, who owns, PetroChina? Nobody, right? You want to own Alibaba. And that's true within the A share market. So the commodity rally, led to this value growth rotation last year in the beginning of, and we're seeing that again. Some of this is, the potential for yield curves to steepen hasn't happened yet, but that'd be good for banks. Who owns ICBC stock? Yields like 6%, but nobody. You own 10 cent, right? So we're seeing this correction, but we think in the long run these are the ways you want to be. And for us as investors, this idea that most of this foreign money is going into these mega cap names, and it's kind of a great opportunity to, quote unquote, add some alpha relative to broader benchmarks like a CSI 300, or in the case of MSCI, the MSCI China, that they have a MSCI China 850. That now what's been weighing on foreign investor sentiment. Some of it is geopolitical. This is from the good folks over at Goldman Sachs, Kinger Lau, great equity strategist for them. That the political, this being a high number, is a very bad thing. But what's kind of interesting is, as we look into the subsets of this Goldman benchmark, is that as much as politicians can't get along, those of us in the business world seem to be getting along just great. U.S. and China economically never been more intertwined than today. I kind of think about the state of Texas just overtook California as the largest exporting state to China. That's LNG oil. There's a lot of great U.S. companies just doing gangbusters in China. The Apples, Nikes, Starbucks, General Motors doing just fantastic. But unfortunately, the political situation is not in a very good spot. And that certainly has weighed on investor sentiment. Now, what's really weighed on it has been the implementation of some regulatory, both China and U.S., that's weighed on the China internet space. And again, for China, this is where most managers have owned China. It's not in the Sinopacs or the PetroChinas. It's in these tech darlings, the Alibabas and JDs. Tencent, et cetera. And those names, the first thing that hit this sector, and if you think about that first slide showing the nearly 3,000% return of China tech, that's really these internet companies going back over the last decade. But the first thing they hit was Archegos, so nothing to do with China here, just a over-levered hedge fund, but 5 of those 10 stocks it held were US listed ADRs. But then what really weighed on it was the Chinese internet regulation. We're going to talk about the Holding Foreign Companies Accountable Act. And lastly, at the end of the year was tax loss harvesting. In November, December, if it's Elon Musk or Mark Zuckerberg, you lock in these long-term capital gains, you got to find some losses to offset that. You don't want to pay Uncle Sam too much. And the U.S. listed China ADRs, because they were down, really got hit hard by tax loss selling in November and December, which explains why the names have come back a bit here. But on the China regulation, the important thing to realize is that we in the West view China as this singular entity. China is doing this. It's 1.4 billion people. It's, and the same is true on the government, that the view in the West was China's going after Alibaba, Baidu. It's walking down a list. That's not really what happened. What really has happened in terms of regulation in China is that it's multifaceted, that you have different regulatory buckets or silos, and those regulations are dictated by very different regulators that are moving at different speeds. So over the spring and summer of last year, man, it just felt like China's going down a list and hitting these companies almost in an ad hoc or whack-a-mole fashion. But what you really had was these regulators moving at different speeds. So for instance, the fintech bucket, that's governed by the PBOC, which is different than user data, user protection, cybersecurity, versus antitrust, anti-monopoly, NDRC, MIIT. So it felt like, but that's not what's happening. It's these different regulators are moving at different speeds. But it certainly, and then you had situations, online education, those for-profit companies not allowed to do online tutoring anymore. Terrible situation for TAL Education, New Orient, but that was driven by China's census. That another big theme for this year were how do they get the birth rate, which is down to 1.3 kids per woman in China, well below the replacement value of 2.1, and they discovered that 20 to 25% of urban family income was going to online tutoring for profit. And so by taking that out of the private sector, putting it into the public educational system, they've alleviated a burden, but just a terrible situation for investors, both public and private. Private investors, unfortunately, were very exposed to this area. But similarly, like with Ant and Didi, it's like, look what they did to Ant. Now they're going to do it with Didi. Totally different situations. That in the case of Ant Group, Ant was going to go public right before it was regulated. And the common narrative people say is, well, Jack Ma teed off on the regulator, so they yanked his IPO. That's not what happened. And in fact, just looking at the China version of the SEC, the CSRC, they basically said what they did was they said, Ant Group was going to sell shares, that their IPO prospectus was filled with pre-IPO financials. And just as Ant Group, fintech company, doing things that a bank does, like make loans, going to get regulated a bit like a bank, that would depress their margins, which would make their net income and EPS forecasts and the numbers in their IPO prospectus invalid. And they could stop Ant because it was going to list in Hong Kong. Now, Didi, similarly, knew they were about to get regulated. but they went public on the New York Stock Exchange. And so the Chinese regulator couldn't stop it. Now, having met with Didi just over 2 years ago, I actually think Didi was forced to go public by Uber, which sold all of its shares. We don't hold any Didi, just for what it's worth. And it's interesting because Tencent disclosed that they actually increased their stake in Didi overnight. But the importance of around Didi was, this is a company. The people I met there, super smart. They put Uber out of business in China, but I think they were forced by potentially Uber or private equity investors to go public. The people there were just too smart. Like they wouldn't do something so dumb. That's pure conjecture on my part. But I think there's no way they didn't know they weren't going to get regulated. I think they got forced. But now some of this element of regulation in China is similar to what we've seen in Europe. That there's a thing in Europe back in 2018, they did this thing called the General Data Protection, which simply said that when you download a free app on your phone, it's really not that free. That app is reading everything, listening to your conversations, your text message. That app has access to everything you do on your phone, your location, and that free app monetize itself by selling that data. And what they did in Europe was like, no, you can't do that. Now, as part of that, in November, I was traveling in Europe for work and, visited 4 different countries in Europe: UK, France, the Netherlands, and Italy. And what was I kind of shocked, just checking on how badly my New York Giants were doing, was that a lot of US websites don't work in Europe because they can't adhere to the GDPR. So the New York Daily News doesn't work in any of those 4 countries. At least that was my experience. And so, and it's kind of shocking, we don't hear about the great European firewall, do we? But it exists. And it's not my, who knows if that comes here, but potentially with the new FTC chair, we'll see. A lot of lobbying taking place from US Tech in DC these days. But now again, what we're seeing is, you had Archegos, China regulation, Holding Foreign Companies Accountable Act, tax loss selling. Investors are just professional investors. A lot of them just came out of these names. Again, some of that money went to India, some of it went into these Chinese A shares. But this data on the right-hand side, I'm sorry, this is not very easy to read, but it would show you that it's about a 350 basis point underweight within active funds versus MSCI China. That this gap is starting to narrow, that we're seeing some investors come back, really, I think driven by the very inexpensive valuations on, particularly relative to India, which looks pretty expensive. The important thing is this price action in these stocks, because you've had this exodus out of the names, was not really driven by the fundamentals, that the companies themselves have adhered and adopted to the regulation. In Tencent's Q3 quarterly earnings call, Martin Lau spoke about, he said, the user protection laws went into effect September 1st, November 1st. So if it's law, doesn't that mean this internet regulatory cycle is over? Aren't the companies adhering? So what I think is important is, like, Alibaba, they grew revenue in they've got a very funky fiscal calendar, but their calendar year Q3 2021, they grew revenue 29%, but over the next month and a half, they lost 100 billion in market cap. Again, the people weren't selling necessarily because of the fundamentals, but more for reasons regulatory tax loss selling. Now, some of the companies are like Alibaba. The net income and EPS was a bit of a miss in that Q3 due to they're investing in their company. They're doing CapEx. But certainly that's made the space very inexpensive from a historical basis. If I put up these valuations relative to US tech it's just not fair to US tech, how high nosebleed some of those valuations are. And I think what's important is that, what's happened is a little bit of profitless technology companies are under a lot of pressure. And in the China space, they've not discriminated between the profitless companies versus the profit. They've all come down very, very significantly. And I do want to spend some time on a real risk, which is holding foreign companies accountable. But real quick on why is this regulation happening? Why? So many times when there's stuff happening around China, you see the headlines. Not very often people think about, why are they doing this? It's kind of like the unfortunate situation, very unfortunate situation with the for-profit education space in China. But when you dig into it, there's a rationale for what they did. I don't agree with it. Certainly don't like it. But I can understand it. And why is this internet regulation happening now? Now we've all read about, President Xi will go for and get his third term this fall, but no one really talks about why does he need a third term? Well, our take is a little bit of a mosaic theory, trying to piece things together is, there is a implied retirement age for government officials at the age of 68. And what's important is China runs, we have a 4-year presidential cycle. China, it's a 5-year, 5-year plan. They've got a 5-year, political cycle. And what's important is today and over the next 5 years, it's not just Xi being, 68. It's 5 of the 8 most senior people in China. Premier Li, 68. Liu He, vice premier, trade envoy, he's already over 68. He already got an exemption during the trade war to stay on. So why this is important is this fall, this party Congress is going to be the most important event in China in many, many years politically. And if we think about how is news disseminated today, well, it's not walking to the end of your driveway, picking up the newspaper. It's online. It's Twitter, it's Facebook, it's YouTube. And the same is true in China. So we think an element of this regulation, why, if China had to deal with a trade war, tech war, COVID, all of a sudden you wake up, it's 2021. And out on the horizon is the most politically sensitive year in China. How do you control some of these changes if they come this fall on social media, on online media? It's you have to regulate it to control it, to make sure that the message is not proverbial fake news. That's why we believe this regulation took place. It's also why we, as well as others, believe that this regulatory cycle is very likely over in China. And in fact, it's been exceedingly quiet on the China regulatory front. A key indication for us the cycle might have been over, besides these laws going into effect in the fall, was the vice premier, the trade envoy Liu He, gave a speech where he talked about the importance of the digital and private economy. And that speech was then published in the People's Daily. So China's never going to give, the government or policymakers, they're not going to give a leak to Reuters or definitely not Bloomberg News or Wall Street Journal. Or Financial Times. They're going to communicate through the People's Daily. That speech got a lot of coverage in the People's Daily, and for us, that was like, aha, maybe this cycle. And if you think about it from the China side, it's been real quiet. Now there's been other factors weighing on the space. The SEC, chimed in around these variable interest entities. Bloomberg in December said, they're going to just unplug this variable interest entity that, the structure that's been used to allow Chinese companies to list, not only here in the United States, but in 10 cents of VIE, Hong Kong names in addition to US names. It's not unique to the United States. And in fact, it's not unique to public companies, very widely used in private equity. There's actually VIEs listed in China on the Shanghai Stock Exchange. If you like, we actually interviewed the #1 private equity lawyer in Hong Kong. Marcy Ellis works for Morrison Forrester in Hong Kong. We did an interview with her on VIEs. She's probably the #1 expert on the VIEs. And that's just right on KraneShares.com for free. Or ping us and we can send you this interview. She talks all about how widely used the VIE structure. It's not, it's not anything wrong. But again, the headlines were, oh, this is going to go away. The Chinese regulator said no, that article's false. On the Holding Foreign Companies Accountable Act, this is this long-running issue of Chinese companies listed in the United States don't provide, their auditors can't provide their audit reviews to the PCAOB, the Public Company Accounting Oversight Board. The PCAOB was created following the Enron WorldCom scandals, that the Sarbanes-Oxley. And so the PCAOB is kind of like an auditor's auditor. And the idea was to ensure that, auditors were doing a good job. And after a while, after applying this to US companies, they said, you got these Chinese, ADRs from foreign companies. So we want to audit those. If it's, a US ADR, it's listed here in the US, we want those audit reviews as well. And they went down a list where, up until 3 years ago, only France, Belgium, and China hadn't signed on with the PCAOB to allow this audit review. Today, it's only China. So after the Luckin Coffee fraud, this issue became politicized. It was like, aha, here's this Chinese fraud. It's let's delist these stocks. And that law got signed into effect in December of 2020. Gary Gensler in his Wall Street Journal op-ed, insinuated that he's going to backdate the start date of this delisting. The SEC, it's important to remember, is simply the enforcement agent. That this is law. Congress, the House and Senate passed this. The previous administration signed it, and again, the idea was we're going to hurt China by we're going to delist these stocks. And I vehemently disagree with the notion that these, by delisting these stocks, you're hurting China in any shape, form, or fashion. That $2 trillion of market capitalization is held by US and global investors. In fact, Chinese investors aren't allowed to diversify outside of China. They can take out $50,000 a year. So there might be some de minimis ownership, but let's be real here. US investors and global investors own these stocks. And so you're not hurting China. The other important thing to realize is that these companies were allowed to list here in full acknowledgement and awareness that they couldn't adhere, that there's a law in China that says you can't allow this. I'm a big believer that China should adhere to this global standard with the PCAOB. They do great work. The companies themselves are all audited by the big four accounting firms. Luckin Coffee's fraud was actually discovered by Ernst & Young. So I don't think there's a problem with the accounting work on these companies. If you think there's a problem with the accounting work, then you've got a big problem, because those same accountants do the China line of all US multinationals that operate in China. So I don't think there's a problem with the audits. This is a real risk. This is a real risk. And I think the risk is just the political environment, that there's just not going to be a willingness to do anything to stop this. I unfortunately do believe that, that I think politically, the current administration doesn't want to be viewed as soft on China. That going into the midterms or a re-election campaign, you can't give potential GOP challenger any sort of ammunition. Now, what I think is a risk for investors is we at KraneShares have started down the path of converting out of the U.S. names into the Hong Kong listings. Of that, this is the greatest thing ever for the Hong Kong Stock Exchange. I kind of jokingly call the Holding Foreign Companies Accountable Act the Hong Kong Investment Banker Employment Act. That these companies have all started to relist in Alibaba, Baidu, Bilibili, Baozun, JD, NetEase, Yum China, Xpeng, Li Auto, Beijing is a biotech company, more recently Weibo. And in fact, the Hong Kong Stock Exchange, effective Jan 1, loosened their listing requirements to allow all of these Chinese companies to relist in China. So I think by the end of this year, virtually all of the US names, less names under 100 million market cap, will have relisted, and that will allow investors to convert it's a tax-free exchange out of, say, BABA US to 99HK. And I would say what we've seen is many of these companies have converted their treasury stock out of the US line into the Hong Kong. Now China, like my kids, doesn't like to be told what to do. So I think for the Chinese government, the US saying you're going to do this, I don't know, doesn't work with my kids very well. I don't think it's going to work from another sovereign nation. Now, on the positive side, and I would say there's a debate out there. Recently, just a week and a half ago, Reuters did this. They had the Chinese regulator met with all the big global banks and brokers doing business in China and said, hey, what do you think? The Fed raising rates, how's that going to affect China's economy? But three people came out of that meeting from global banks or brokers and said, within that meeting, they said that there would be a positive surprise to the Holding Foreign Companies Accountable Act by June or earlier. I hope so. I am not rooting for this to happen by any mean shape at all. We don't want to leave capital markets. We continue to advocate in Washington, D.C. that this is a very bad idea. We recommend that, if you need help navigating D.C., we'd love to have more people helping us on this, quite candidly. And if you hold a US ADR, I would definitely call your custodian or your broker dealer and make sure that you can do an ADR conversion. But there's hope, and I think there's a part of me that says that this issue, it's just so embarrassing for both sides that you can't work this one out, and this seems pretty easy. So hopefully, I just, as a fiduciary, as a steward of our investors' capital, I can't wait to the 11th hour. I can't wait for a Hail Mary to see a resolution. And so we've started down this path, and certainly I do think this is a big risk. And happy, feel free to follow up. But this is a real risk. And shortening the window. There's talk about now they want to shorten the window from 3 years to 2 years. So this goes from 2024, kind of call it mid-year, late year, to delist to next year. The window gets shortened. This is happening next year. And I think this is a big problem for individual investors. A lot of retail broker dealers don't allow ADR conversion. Not a lot, some do. But you think anyone at Robinhood knows what ADR conversion is? Do they even know what an ADR is? Potentially a big issue. Now, helping on the regulatory cycle, this just came out the end of last week was 4 of these regulators we've mentioned, the cybersecurity, MIIT, NDRC, cyberspace. They held a meeting with 27 of the companies. Now, what's interesting about the release that from these 4 regulators was the positive way it spoke to the China internet space. And I think that's why you're seeing some folks, UBS, Goldman, great teams on the research side there. Why they've recommended the space is because of some of the things like they're seeing that we're seeing, which is mainly worried about the China internet regulation. This was a great sign, another indication it's over. As mentioned, I'm more worried about U.S. regulation than China regulation. The companies themselves certainly think that their stock is cheap. Alibaba, Baidu, Tencent were buyers back in the summer. Tencent started buying back stock. They did some stock buybacks in January. Tencent is going to give its ownership stake in JD to its shareholders. This is a very shareholder-friendly move from Tencent. I think Alibaba, once they report earnings later this month, don't have the date yet, unfortunately, but I think they'll announce another buyback. Certainly some other positives. We saw, Charlie Munger, he's had to rebuy Alibaba a few times. Apparently, I'd recommend a more diversified approach, but that's self-serving and highly biased. But another thing we saw was Kwashu Technology. So we talked about northbound stock connected allows foreign investors to go into China. You got southbound. So southbound allows institutional investors, mutual fund families, insurance companies, buy stocks in Hong Kong. And Tencent and Meituan have been in there, but they added in September of last year. They added Kwashu, a tech name that had gone public earlier in Hong Kong. They added it now, and sort of like why would they allow mutual fund families to buy this company that killed the company? They wouldn't. Interesting, you probably saw XPeng's stock absolutely cook yesterday, go up dramatically. That's because XPeng had relisted in Hong Kong, and they got added to Southbound Stock Connect. And so all of a sudden, these mutual fund families in China can buy XPeng. I would anticipate Li Auto could get added to Connect, another China EV name. We are investors in both companies. So a lot, always something happening with China, both economically, capital markets, in the news. I'm joined today with my colleague Brian, who helps cover Georgia for us, and certainly happy to take to entertain any questions. And certainly if you wake up tomorrow, please info Brian. We're always available. So please don't ever hesitate to reach out. We're always happy to help members of the CFA Society of Atlanta.
Yeah. Thanks again, Brendan. And thanks everyone for taking the time to join today. So I know we're kind of running up against 1 o'clock, so we'll kind of just jump into maybe some of the Q&As. And the first question, Brendan, I guess, where are you kind of more bullish in China and EM for the next 1 to 3 years? Would it be more kind of in the value-oriented names, more kind of the A shares, or more kind of the growth?
Yeah, great question. And total cop out, own both, right? That I think, I disagree with this view that EM or China's out of favor. I think it's more been this preference for growth stocks, if it's the Taiwan semis or Samsungs, the Tencents and Alibabas within EM, more growth orientation. But I think some on the value side, I just think there's some really good value high dividend payers. CLSA, their equity strategist, Damon Kestel out of Australia, did a great piece last week on the value dividend opportunity. And some of these yields in not only China but within Asia look really appealing. So I think the hard thing around some of these dividend payers is that you've not historically seen much to any principal appreciation. And so I think you got to balance the two. And I think this is true for China as well as broader EM. You got to balance the two. And that's where we've always recommended, Celia mentioned KWA has been our big, but I've always said, own some, some of our China A exposure as well. Do a little bit of both, and you can kind of rebalance between the two because of these value growth, zero overlap between the two. So I think I think there's a real home bias in the U.S. I think people are really underweight non-U.S. in general, and I think it's just because if your implementation vehicle's been a broad EM or broad China, you've not done well, and I think that will improve under the value comeback, and that that's something that I think can happen. But I think over time, people are always going to gravitate. For EM, you want growth, and I think people will gravitate back to these growth names.
Perfect. And then obviously, kind of before you touched upon the A-share outperformance in 2021, especially compared to kind of offshore technology. What do you think was kind of the biggest driver of kind of the outperformance of A-shares? And maybe some of the catalysts that you see for China tech, kind of the offshore names this year.
Yeah, I think it's the outperformance driven by investors in China saying, listen, China's economy is doing great. Rebounded in 2021 up 8.5%. Economy is doing well. That's good for the stock market. As China eases, asset classes compete with one another. So as bond yields come down, makes stocks look more attractive. And that thesis played out. We saw really, really strong earnings per share growth last year for Chinese A shares. And I think that trend will continue, but albeit at a slower pace. And I think that's where within this global value growth rotation, it's happening in China in a big, big way. Unfortunately, CATL, the big global EV battery maker, was down almost 6% today in China, but it's been such a widely held name by foreign investors as well as domestic investors. So this value growth rotation's got to play out a bit more in the A share market. Probably related a little bit more why I'm very heavily invested personally in our ETFs, and my two biggest positions have always been our China A fund, KBA, and then also KWEB. I've been a buyer the whole way down. And I'm Morgan Stanley, Jonathan Gardner's team put out a great piece showing that the put call ratio in the Hang Seng Index is at a low only seen twice previously: the dot-com bust and the global financial crisis, and today. So I actually think so many people have come out of the Hong Kong US names that if you forced me to say, I'd be more of a buyer of those names, just as this value growth dynamic plays out in the A share market. But I hold them both pretty significantly.
Got it. And then kind of in terms, I know a lot of investors, often kind of contact us for thoughts around, this potential US-China kind of cold war on tech, kind of this tech war, which includes industries such as chips. Obviously, there's been stories in recent years around Huawei and ZTE. How do you kind of see that relationship, over kind of, the next few years? Do you see an improvement? Kind of, more of kind of a decoupling within these industries?
Yeah, I mean, generally I do not buy into this Felicity's trap. Graham Allison. Who am I to critique a Harvard professor? But this idea that China and the U.S. A rising super. To compare the U.S. and China today, with Carthage and Rome, or Athens and Sparta. I mean, I think it's laughable. Get on an airplane, pick up the phone, do a Zoom call, figure it out. And I think where some element of this is a lot of bark, but there's not a lot of bite. That if the U.S. and China economically, you cannot decouple. I'm sorry, like that ship sailed. We are very, very intertwined economically, and where I think this view of a proverbial, almost like the 50s space race, which has created another 50s McCarthy era type of situation in DC. People are afraid to say anything. But I think that view's misguided. I think it is happening, but I don't disagree. I think ultimately, similar on the tech side, this is going to be a total disaster for the Qualcomms, Microns, even for Intel. They're big buyers. And so I think even on the past administration, you've seen a lot of bark. It's like the tariffs. Like it's pretty easy to get an exemption to a tariff. You just got to hire the right lawyer in DC. But it makes for a great headline. So tariffs aren't going to go away, even though they're causing inflation. Janet Yellen said that, just because because they want to. This administration, like the past, wants to look tough on China, but I don't see that going away. But at the same time, my biggest worry is that, DC learns an economics 101 lesson the wrong way. There's almost 400 billion of revenue generated in China annually from US companies. That's, and on, recently, it's been, China didn't make its, didn't meet the trade deal. Well, one, if you add the 400, if you add that 400 billion to China's trade deficit, it basically goes away. And that is China's view. That's that US companies own factories in China, then manufacture and sell, all across Asia as well. That's why one of the reasons the factories are in Asia is just because the proximity to the majority of the world's population. But so the China side doesn't believe that there's a trade deficit. But I think the more important thing is yes, they didn't make this trade, but there was a global pandemic. And then if the 737 MAX hadn't had the problems it's had, I think they would have made, they would have come close to those commitments. So I'm not, unfortunately, this tech thing it's not going to go away. That's very clear. But that's, so be it. It's a shame for US tech companies, but we got to abide by the rules.
Right. Yeah, and then just one last question, just going back to the ADRs. So Jonathan had pointed out that we have about 33 US listed Chinese companies in KWeb today. If you want to just kind of talk about the plan that we have, to convert out of the US listing into the Hong Kong, and what percentage maybe today is able to convert, I think that would be kind of helpful.
Yeah. So the majority have been able, you've got a lot of the companies have relisted. Again, the Hong Kong Stock Exchange announced in mid-November that they're going to relax the rules for overseas issuers relisting. That law that went into effect on January 1. In speaking with the Hong Kong Stock Exchange the week before last, to people in their listings department, it said, why haven't we seen more companies relist? And what I learned was that you can actually file confidentially. So a lot of the, you have companies that historically weren't able to relist because they weren't profitable, like a Pinduoduo, or you had companies that went public within the last 2 years. And that was one of the rules that went away, was that if you listed in the last 2 years, you weren't allowed to relist in Hong Kong. And that would be like a DD, Full Truck Alliance, KE Holdings. And I thought there'd be a lot of filings in January, and speaking to an investment banker involved in this, they had mentioned that, it can take 6 to 9 months to start to finish. But, I think a lot of these companies, the impression I got from the exchange, the Hong Kong exchange, was a lot of these companies have confidentially filed. So I check every day, but I anticipate all of these companies are going to go. And again, this delisting risk, and it pains me, but it's unfortunately a real. So we've already converted a third of our Alibaba, Baidu, NetEase, and JD. We're going to continue that trend and apply this as the volumes in these underlying stocks picks up over the next year. I don't think we'll hold any U.S. names potentially within 11 months.
Thank you, Brendan and Brian. And thanks to everyone who is connected with us today. Please look for an event survey to follow, which will include the webinar replay, as well as the meeting presentation. We hope you'll take a moment to respond to the survey. They're very important to us. And again, thank you to everyone, especially Brendan and Brian, for making today happen. Yep. And Kathy Ford as well.
Thank you,
Thanks, gentlemen.
Cecilia, and Kathy.